Hello there, fellow insurance professionals. This is Doug McLaughlin. I'm speaking today, and I'm standing in front of what used to be a vacant sports authority that has recently been converted and soon to be opened into medical office space. And, on that topic, I was reading an article online the other day about how with Amazon and Target and so forth, so many so many buildings, retail spaces are going vacant and being turned into things like medical offices or just sitting there vacant. And I want to make a video today to explain the 5 things you might want to look out for or be aware of when you're trying to broker insurance on a vacant building. This isn't me acting as an expert or even me trying to solicit a business. This is just me speaking as one insurance professional to another. And I would say the 5 things you want to kind of look for or keep in mind that an underwriter considers when dealing with a vacant space. The first thing they want to look at is who owns the building. What is the moral hazard? In other words, is the owner individual? This is a building now that's not producing income. And if they are individual and it's not producing income, if it's worth more in a claim than it is standing, that's the concern. So how you address that is by knowing, do they pay their property taxes in full? Have they been a long-standing client? Do they have good credit? Most underwriters are going to look up Dun & Bradstreet. Now, what if your owner of the vacant building isn't necessarily an individual? Let's say it's a group, investment group, receivership, a lawyer, a trustee in a law office. You might not have to worry about moral hazard, the risk that the person would make money burning the place down, because why would they? They're an attorney or a banker sitting in an office in New York City. But what about the morale hazard? In other words, why would they keep this building up? So you can address that issue by talking about do they use a property preservation firm? Do they have a watchman? Do they have a maintenance guy? Is it actively being listed as a real estate where a realtor is bringing potential buyers in on a regular basis? And that will address the issue of morale hazard as opposed to moral hazard. Because if someone's coming and visiting the property on a regular basis, then chances are they're going to notice when the pipe is dripping and so forth. On the topic of pipes and plumbing, you do have to be aware here in the upper Midwest, obviously in the winter it gets cold. If the temperature drops below 32 degrees, guess what? Pipes break in frozen weather. So do they keep the heat on? Or if it's going to be vacant throughout the winter, are they going to just simply drain the pipes? That's something that you should talk with your client about before and know the answer to that. Underwriters will want to look into that because obviously pipe breakage is a big hazard and peril on vacant real estate. On the same topic of hazards and perils, there are people who go in and break into vacant buildings for the sake of getting plumbing, copper from the pipes to salvage and sell it. Because of that, security. What security provisions do they have? Do they have a CCTV? Do they maybe have a night watchman, a central station alarm? And be mindful of the fact that theft is the actual loss of the stealing of items, but there's also vandalism and malicious mischief, which is, when they take the sledgehammer to the wall to get to that plumbing and all the damage they do. You can have a huge claim from the resultant, taking a sledgehammer to some plumbing and see what happens. It can make a big claim. So to that extent, you're going to want to address that with your client and the underwriters, and you want to make sure you have coverage for theft if you can get it. You probably will need to engage in some sort of protective safeguard to do that, central station alarm. But be careful to read through the forms, because if there's a form that excludes vandalism, for instance, that might kind of offset what you're trying to get. I remember one time I had a risk come to me and they said that the coverage included all risks, including theft. And they had no security whatsoever. And I said, well, I'd like to see this quote. Well, on page 1 of the quote, they said all risk, including theft. On page 2 of the quote, they had an exclusion of theft of metal alloys and plumbing. They had a vandalism exclusion. And they had several other limitations as respects to theft and vandalism, not an outright theft exclusion. In other words, if someone came in and stole the shag carpeting of the place, they would be covered, but pretty much otherwise they weren't. So look for those coverage terms, especially if you're using a non-admitted carrier. They make sure there's no restrictions or exclusion your guy can't live with. And finally, if you're dealing with non-admitted carriers, which most surplus lines markets are going to be your vacant building markets, pay attention to the premium terms. Non-admitted carriers can have accelerated earned premiums. The rule of thumb is generally an underwriter, for the hassle of working on the account, wants at least 3 months worth of premium. So be aware of that, because if they sell the building or they renovate the building a month after they bought insurance, they just need to be aware that they're still going to be expected to pay the minimum earned. Well, we hope to do a more series of videos from agents to agents on practical and pragmatic information that you can use to help you when you work with your clients.